Imagine this, you're on a roller coaster, it climbs slowly, building anticipation, then suddenly it plunges. Your stomach drops, you feel a rush of adrenaline. That's what the ETF market can feel like sometimes, a mix of exhilarating highs and stomach-churning lows. Lately it's been more of a downward spiral. You see the headlines, ETFs tumble, market volatility spikes. Suddenly that comfortable nest egg you've been building feels a little less secure. It's perfectly normal to feel anxious when the market takes a dip. We've all been there. But remember, panic is not an investment strategy. Let's take a deep breath, break down what's happening, and explore how to navigate these choppy waters. So, what's causing all this commotion in ETF land? Think of it like a storm brewing. You've got dark clouds of inflation worries, strong winds of rising interest rates, and maybe even a bolt of geopolitical uncertainty thrown in for good measure. These factors create a perfect storm that can rock the market, and ETFs, which are baskets of stocks, ride those waves up and down. Remember, ETFs are designed to track a particular market index or sector, so when that index or sector takes a hit, so does the ETF. For example, let's say you own an ETF that tracks the tech-heavy Nasdaq 100 index. If tech stocks stumble due to concerns about future growth, your ETF will likely feel the pinch too. Let's bring this to life with some real-world examples. Imagine you invested in the popular SPY ETF, which mirrors the S&P 500 index. Over the past year, it's been on a bit of a roller coaster ride, dipping by, say, 10%. That means if you invested $10,000, your investment would now be worth $9,000. Now let's look at a sector-specific ETF like the SOXX, which focuses on semiconductor companies. This ETF has been hit even harder, plummeting by, say, 20% due to supply chain disruptions and slowing demand. A $10,000 investment in SOXX would have shrunk to $8,000. These examples highlight the importance of understanding what your ETF tracks and the risks involved. Remember, not all ETFs are created equal. Some are designed for growth, others for income, and some for specific sectors. Knowing the difference is crucial. Section 4. Riding the wave. How are investors navigating the dip? In times of market turbulence, it's easy to get caught up in the frenzy. But remember, every investor reacts differently. Some investors, driven by fear, might hit the sell button, hoping to cut their losses. Others, seeing a buying opportunity, might buy the dip, believing the market will rebound. There's no right or wrong answer here. It all depends on your individual risk tolerance, investment goals, and time horizon. However, it's essential to remember that panic selling can often lead to locking in losses, while buying the dip without proper research can be like catching a falling knife. Section 5. Don't put all your eggs in one basket, the power of diversification. Think about it this way. Would you put all your money into a single stock no matter how promising it seemed? Probably not. The same principle applies to ETFs. Diversification is key to mitigating risk. Instead of putting all your investment eggs in one ETF basket, spread them across different asset classes, sectors, and geographies. This way, if one area of the market stumbles, your entire portfolio won't crumble. Imagine your portfolio as a delicious pie chart. You might have a slice for US stocks, represented by ETFs like SPY or VUO, a slice for international stocks, VXUS or IEMG, a slice for bonds, BND or AGG, and perhaps even a sliver for commodities, GLD for gold or DBC for broad commodities. Section 6. Weathering the storm safe havens for your portfolio. When the market gets rough, it's natural to seek shelter. In the investment world, certain assets are considered safe havens because they tend to hold their value better during downturns. Think of government bonds like the trusty umbrella in a storm. They might not be the most exciting investment, but they offer stability and income when you need it most. Another safe haven is cash. While it might not generate significant returns, having a cash cushion allows you to take advantage of buying opportunities when the market dips. Remember, buying low and selling high is the name of the game. Section 7. Charting your course. Seeking expert guidance for smooth sailing. Navigating the choppy waters of the ETF market can be challenging, especially during downturns. Remember, you don't have to go it alone. Seeking guidance from a qualified financial advisor is like having an experienced captain on board your investment ship. They can help you, Assess your risk tolerance and investment goals, create a diversified portfolio tailored to your needs, navigate market volatility, and make informed investment decisions, and stay on track to reach your financial destination. Remember, investing is a marathon, not a sprint. By staying informed, diversifying your portfolio, and seeking expert advice, you can weather the storms and sail smoothly toward your financial goals.